Top three things. Number one, the U.S. dollar. Number two, the 10-year bond yield. And number three, I'm going to go with all of Asia. A very interesting session in Asian equities, specifically last night. But first, on the dollar. The dollar is at 2-month lows. So again, why is the dollar at 2-month lows? Two reasons. One, the Fed, easier. Two, and again, that's based on a worse than expected GDP number for the first quarter. So slower growth rates and lower inflation rates equals lower for longer on interest rates, weaker dollar, Fed easier. The other one is the Greek non-exit. So again, we have not been in the camp that the Greeks are going to exit. We're not trying to sell you advertising on your favorite financial mainstream media website. We are trying to tell you with the best probability way that we can what is going to happen across the board in macro. And no, we don't think that Greece is going to leave the European side of things anytime soon. So that would be the point number one. Again, U.S. dollar immediate term trade oversold on both of those things. Those are big things, both on the European versus the dollar side and on the dollar side versus Fed policy in and of itself. 10-year bond yield, second thing. This is the most important thing this morning because we're testing the top end of the immediate term risk range. That's a mouthful, but that is the immediate term. The intermediate term trend, of course, in the 10-year bond yield or interest rates remains lower. For those of you who have been following this closely and keep yourself holding to the facts, the 10-year bond yield last year was about 3%. Then it dropped to 1.6, 1.7%. It bounced, started the year at 2.17%, and now you're at 202, 203. So the question is, where within the immediate term bounces are bond yields going to stop going up again and make lower highs? And again, it could be today. We're going to have to see. The GDP number is one way to look at bond yields. Again, lower for longer because growth is not there in terms of how the Fed looks at it. The other one, of course, is what the Fed says at 2 o'clock. Now, they're not going to host a meeting. They're not going to have a Q&A. They're just going to release the hounds. We're going to have to read and react on this. If the Fed's as dovish as we've expected them to be, then you have downside in the 10-year bond yield to 185. If they're remotely not dovish, I think that's what the market, by the way, is getting nervous about. Remotely not dovish, because now everyone's kind of come to our expectation. All the bond bears have been taken out back, and slapped around. You've had all the people in consensus say, okay, these guys in Stanford are right, lower for longer. Gunlack has obviously had this call too. It's not just us. And again, consensus is now the problem on bond yields. So if they're not dovish enough, I think that that's the upward bias, I guess, pressure in the very immediate term on bond yields that are making bond bears who've been wrong for the last, 25, 30% of the move feel good for a couple days. Now, finally, Asia's not going to make you feel good overnight. It was probably the worst session overall in Asia, and that's maybe because Japan was closed, so they couldn't officially have a good session in Asia from the Japanese front. Don't forget that Japanese stocks do well when the economic data is horrible. So again, that's the whole point. Japan was closed, China was not up, and the rest of Asia, or the eastern part of the world, fully loaded with Australia, which was down 1.8%, was really nasty. Now, Indonesia, for example, I know you don't wake up hearing about Indonesia. I think I heard CNBC talking about some dude who was in jail talking about, the currencies in jail. I mean, guys, come on, let's talk about the macro markets. Again, it's not that hard. Again, macro markets, Indonesia matters. Big country, Asia, down 2.5% overnight, down 7.1% in 3 days. Again, what's going on in Indonesia? I have no idea. But again, it's something that you should get up to speed on right here and now. I guess we do actually have an idea. I shouldn't belittle our process, so you could ask Darius Dale, who covers Asia, about that. But it wasn't just Indonesia. It wasn't just Australia. It was India. India continues to go lower. Again, the bounces aren't there. Again, we talked about this yesterday on the Macro Show. For those of you who subscribe to this all the time, you hear us following these markets in real time. Indonesia continues to outperform alongside India now. So again, two big problems going on in Asia. And then finally, the Chinese point, just to round off the Asian kind of circuitry of it all. China, the People's Bank of China has a chief economist, okay? Some dude who has all 10 fingers because he's in line with what the overlords there want to say. He said, and I quote, I better quote this specifically, no need for quantitative easing. He actually called it QE. He didn't even call it quantitative easing. At least in Japan, they call it QQE and other things. He said no mas. So what's going to happen? I mean, the Chinese stock market actually went down on that, and then somehow the day traders gapped it up into the close to close it flat. But again, net, that's a big problem in Asia overnight when I look at everything that happened in terms of interconnectedness of it all.